Welcome back to Investing Talk Podcast.
Today we're looking at HIMS and HERS Health.
As usual, before we start, subscribe, like, and comment to this video to support the show. We really do appreciate every single click.
We really do. And look, today is going to be intense. We've covered a lot of health stocks, but HIMS and HERS, it isn't just a telehealth company anymore. It's officially become a battleground stock. We are talking about a company that is actively disrupting the, $100 billion weight loss market?
Battleground feels like exactly the right word. It is getting spicy out there.
Yeah.
I mean, they're essentially poking the bear, or, the pharmaceutical giants right in the eye. They're undercutting big pharma with a $49 a month price point.
Just $49.
And that has sparked legal threats, massive volatility, a lot of headlines.
Exactly. And that really sets up the central question for us today, and really for any investor looking at this ticker right now. Is the recent stock slide a buying opportunity into a company that's growing revenue at nearly 50%? Or is the regulatory risk just too high to touch?
That is the million-dollar question, or maybe the billion-dollar question given the market cap. But before we get to the legal drama and all the scary headlines, we need to ground this in reality.
Okay.
Let's pivot to the hard numbers. I want to look at the financial health because stories are great, but, numbers don't lie.
Right. And the numbers here are, they're actually staggering. If you look at their trajectory, specifically the Q3 2025 performance, revenue hit nearly $600 million.
$600 million?
And that's up 49% year over year.
Hold on. Let's just pause there for a second. 49% growth.
49.
Usually when companies get to this kind of scale, growth starts to taper off. It's the law of large numbers, right? It gets harder to move the needle.
That's the law of large numbers, exactly. But HIMS is defying that. To give you a sense of the scale they've reached, their last 12 months revenue, the LTM is approximately $2 billion.
$2 billion.
Just think about that. In 2023, they were under $1 billion. They have effectively doubled the size of the business in a very, very short window.
Okay, I'll play the skeptic here because that's my job. Growing revenue is great, but anyone can sell dollar bills for 90 cents. Is this quality growth?
That's the right question to ask.
Or are they just burning cash to get those top-line numbers? We've seen it a million times.
Right, but the consensus projects continued revenue growth of about 30.3%. And this isn't like empty calories revenue.
Okay.
This is driven by very specific, high-demand, personalized health offerings, weight loss, lab testing. They're selling subscriptions to health outcomes, not just low-margin pills.
Okay, so the top line's moving. What about the margins? Because that's usually where these high-growth tech or health plays fall apart.
And they are holding up incredibly well. Gross margins are sitting near 75%.
75%?
Yeah.
That sounds more like a software company, a SaaS business, than a company shipping physical products.
That is the beauty of the telehealth platform model. It gives them huge leverage as they scale. You build the infrastructure once, and adding the next 1,000 patients costs, incrementally less.
Right.
But the metric that really stands out to me, and this is what separates real businesses from the hype, is the operating margin. It's improved to about 6% LTM.
Which, for context, is a big deal because back in 2023, those margins were sitting in negative territory. They were losing money.
Precisely. We are witnessing the profitability turn.
Yeah.
Net income actually turned positive, nearly $16 million in Q3 2025.
So they are actually making money now. That completely changes the conversation from will they survive to how big can they get?
And if we look at the cash position, it reinforces that stability. They're generating positive free cash flow. Adjusted EBITDA was over $78 million in Q3 alone.
And just to define that for everyone, because we throw these acronyms around, adjusted EBITDA, it's basically a quick way to see how much cash the core business is generating, right?
Exactly, ignoring all the accounting tricks and non-cash expenses.
And $78 million is a very healthy cushion.
It is. It means they control their own destiny.
And I'm looking at the balance sheet here. I see no noted debt burdens, no red flags, and it looks like they're using that cash for subscriber acquisition and new products, not trying to prop up the stock with buybacks.
Which is exactly what you want to see in a growth phase, reinvesting. And that leads to the competitive moat. HIMS and HERS isn't just a website.
Right.
It's a direct-to-consumer platform with high switching costs. Once you're subscribed, with integrated fulfillment, it's sticky.
Sticky usually means it's a pain to leave. But let's talk about the carrot, not just the stick. We have to mention the specific product driving that stickiness.
The needle-free compounded GLP-1 alternatives.
Okay, let's unpack that jargon. Compounded GLP-1, what are we actually talking about here?
So GLP-1s are that class of drugs like Ozempic, Wegovy, that mimic a hormone to signal you're full. Compounded means a pharmacy mixes ingredients to create a medication tailored to a specific patient.
Okay.
In this case, because there's been a shortage of the brand name drugs, HIMS works with licensed pharmacies to create these compounded versions.
And the kicker?
The price. $49 a month. That is the game changer. The brand name stuff can cost, what, over $1,000 without insurance?
$1,000, yeah.
HIMS is democratizing access. And they're layering on top of that with at-home testing, specifically that Gallery multi-cancer detection test. They're building an ecosystem.
That $49 price point is just... it's so aggressive. I love it as a consumer, but I can see why the big guys are nervous. Okay, fundamentals look robust.
They do.
But the stock chart, that tells a bit of a different story. Let's pivot to the charts and the technicals.
Let's do it.
Because if you just looked at the price action, without knowing the revenue growth, you'd think something was broken. The stock is trading near $26. It's declined 32% so far in 2025.
It has been painful for holders, no doubt about it. If you bought in January, you are underwater.
And we know the cause. It's all the volatility around that GLP-1 pill launch announcement. The market kind of freaked out.
It did. It's a classic sell the news or maybe a fear-based reaction. But here's the counter-narrative. Despite that slide, the financial models suggest significant upside.
To where?
We're seeing targets around $38. That implies a potential 43% gain from these levels.
So you're seeing a disconnect between the price and the actual value.
A massive one. The structure suggests the market is currently just trying to digest this disruption. When you drop a bombshell, like a $49 weight loss solution, into a market dominated by $1,000 shots, you're going to create shockwaves.
Shockwaves is the right word. The weight loss peers definitely felt it.
They did. And while that creates volatility, it also indicates high market attention. The volume is there. The psychological momentum is shifting. Investors are realizing this isn't a flash in the pan. It's a structural shift. If they execute well, the technicals suggest we can see higher highs as that fear fades.
It feels like a coiled spring. I mean, technically, when a stock drops on good fundamental news, it often creates a support level where smart money starts buying.
Exactly. And that gap between the $26 price and the $38 target, that is the opportunity.
But sentiment is a tricky thing, moving on to what the street is thinking, because it feels like there's a real tug of war happening.
That is the perfect way to describe it. If you look at the quantitative scoring, the mood is labeled as neutral. It's literally a 0 on the sentiment score.
Which is so weird for a company growing at 50%. Usually growth like that gets people really excited.
It is, but it reflects that tension. On one side, you have the product launch excitement people realizing the total addressable market here is massive.
Yeah.
On the other side, you have the fear of regulatory pushback.
Right. The analysts seem a bit split, too. I saw TD Cowen made a move recently.
They did. On January 6, 2026, they repriced their target to $37. Now, that was down from $48.
So they cut the target. That sounds bad. Why lower it if the company's growing?
Context matters. Even with the cut to $37, it still implies significant upside from the $26 level we're at now.
Okay, that's fair.
They're being cautious on valuation because of the risks, but they aren't telling you to sell. They're just factoring in a higher risk premium, basically saying, this is worth more, but we need to account for the chance things get messy.
Speaking of things getting messy, or at least looking messy, we have to address the elephant in the room with insider trading. I saw some chatter about the CFO, Louis Amiokoupe, selling shares. That always makes retail investors nervous. It's the classic signal, right? If the money guy is leaving, I should too.
I saw that too, and I'm glad you brought it up because this is where you have to read the fine print. Yes, the CFO sold shares, but let's look at the details.
Walk us through it.
Okay, this happened on February 3rd. He exercised about 5,000 options at a strike price of $5.01. He then sold them at an average of $26.44.
So he bought low and sold high. Smart guy.
Exactly.
Yeah.
And importantly, this was done under a pre-adopted Rule 10b5-1 plan.
Can you just explain what a 10b5-1 plan is? We hear it a lot, but I want to make sure everyone understands why it matters so much here.
Sure. It's a regulation that lets insiders set up a predetermined schedule to sell stocks. They decide to sell months in advance at a specific date or price.
So it's to prevent accusations of insider trading.
Exactly. It means this sale was locked in long before any recent news cycles. It wasn't a panic sell based on something he saw last week.
That's a crucial distinction. It's automated. He didn't just wake up and hit the sell button.
Correct. And here's the kicker. The CFO still has significant holdings, over 91,000 direct shares plus options.
So he sold a tiny fraction of what he owns.
A tiny fraction. This looks like routine profit-taking. Maybe paying for a renovation, a tax bill. It is absolutely not a bearish signal on the company's future.
Good context. It's easy to see a headline CFO sells and panic, but we can't ignore the real scary stuff.
No.
We have to look at the risks because this is not a risk-free trade.
No, definitely not. And the bear case here is substantial. If you're going to invest in HIMS, you need to understand what could kill the thesis.
And the primary threat has names attached to it. Novo Nordisk and Eli Lilly.
The Titans.
They are not happy. They are threatening legal action over these compounded pills.
They're protecting their turf. And they have very deep pockets for lawyers. There's also unconfirmed speculation about FDA scrutiny on compounded GLP-1s in general.
That's the big one. Because right now, compounding is allowed largely because there's an official FDA shortage, right?
Exactly.
If the FDA declares the shortage is over or closes that loophole, does the revenue just disappear overnight?
That is the fear. If the shortage is declared resolved, the legal basis for mass compounding gets shaky. But here's the defense.
Okay.
HIMS has deep experience in compounding. This isn't their first rodeo. They built their business navigating these exact types of regulatory gray areas with hair loss and ED meds. They know the rules.
So you think they saw this coming?
Absolutely.
Yeah.
They wouldn't launch a product this high profile without a fortress of legal opinions behind them. They likely have a strategy to pivot if the compounding window closes. And honestly, the stock slide we talked about,
That 32% drop.
that likely already prices in this risk. The market is assuming the worst. If the worst doesn't happen, the stock re-rates higher.
That's a good point. The bad news is priced in. But what about competition from? Amazon is entering the pharmacy space for Wegovy pills.
Right.
When Amazon enters your sandbox, you usually get crushed.
Usually. But healthcare is different. Amazon has a pharmacy model, yes. They can ship you pills. But HIMS and HERS has a differentiation edge with that $49 price and the telehealth moat.
Explain that moat difference. Why can't Amazon just steamroll them?
Amazon is a logistics provider. They move boxes. HIMS is a personalized health provider. You go to HIMS for the consultation, the prescription, the product, all in one flow. It feels like a brand relationship. And frankly, Amazon isn't offering compounded semaglutide for $49. They're just distributing the brand name stuff at much higher prices.
So HIMS is winning on price and experience, while Amazon is winning on logistics for the expensive drugs.
Exactly. They're serving different segments of the market right now. HIMS is targeting a massive population that can't afford $1,000 a month.
All right, so the risks are real, but perhaps manageable or at least priced in. We've covered the numbers, the charts, the mood, the threats. Let's bring it all home. Where do we go from here?
We look at the timeline because the next 3 months are going to be absolutely critical.
What are the dates we need to circle on our calendars?
First and foremost, earnings. The Q4 and full year 2025 results are coming up on February 23, 2026.
That is right around the corner.
It is, and expectations are high. We're looking for that 30+% growth to continue. If they beat, or if they give strong guidance on GLP-1 uptake, the stock could move fast.
And after earnings?
Shortly after, March 2nd, management will be presenting at the Morgan Stanley Technology, Media, and Telecom Conference.
Those conferences are often where they drop new metrics.
I would expect updates on GLP-1 subscriber numbers specifically. If they can show that the legal threats haven't slowed down consumer adoption, that would be a massive catalyst.
Okay. You've laid it all out. What is the final verdict? Put a score on it for us.
When I look at the whole picture, HIMS and HERS is disrupting a massive market with a clear pricing edge. $39 versus big pharma prices is a winning proposition. They're profitable, they're growing fast.
So the score?
I'm assigning a bullish score of 8 out of 10.
8 out of 10, that is confident.
It is. The reasoning is simple. The strong fundamentals and the impending earnings catalyst, to me, they outweigh the near-term noise about legal threats. The business is working.
So how do you play it?
I view this as a swing trade into the Q4 earnings on February 23rd. You play the run-up and the potential beat. But if they execute on this GLP-1 expansion, this extends into a multi-year hold.
A swing trade that could turn into a marriage.
Exactly. If the thesis holds, you stay for the long haul.
I like it. Clear, actionable, and data-backed. That's an 8 out of 10.
The risk is there for sure, but the reward looks sweeter.
That's it for Hims and Hers Health. Don't forget to subscribe, like, and comment to catch the next one. See you next time.